Canada and the United States have reestablished free trade for the vast majority of our goods.
A gesture in the hopes it will reset the relationship with the U.S.
After months of tariffs and tense exchanges, the tone between Washington and Ottawa has shifted. Prime Minister Mark Carney has announced that Canada will remove many of its counter-tariffs on American goods. He presented this not as a concession, but as a reset. Carney said Canada is aligning with the United States to preserve what he calls the best trade deal any country currently has with America. President Trump welcomed the move and said new negotiations would begin soon. For both leaders, this moment marks the reopening of talks that will shape the next phase of North American trade.
Starting September 1st, Canada will scrap the 25% counter-tariffs it placed on American goods covered by the North American Free Trade Deal.
Donald Trump has relied on tariffs as his main negotiating tool. Since August 1st, Canadian goods outside of CUSMA have faced a 35% duty. On top of that, U.S. tariffs on steel and aluminum remain at 50%, raising costs for North American manufacturers. For integrated supply chains, this has disrupted the just-in-time model that once defined cross-border trade. This strategy mirrors what Trump has done with Europe, which accepted a 15% baseline tariff in exchange for stability. The same logic applied to Japan and South Korea with sectoral agreements. Canada, however, already holds a unique position. Roughly 85 to 90% of Canadian exports to the U.S. remain tariff-free under CUSMA, leaving the effective tariff rate at about 5.5%. By comparison, the global average tariff into the U.S. has jumped to nearly 16%, according to government data released earlier this month. Trump points to these figures as evidence that his pressure tactics are working.
We're matching what the United States has done, what the president has done. We have the best deal of any country with the United States right now.
Our hope is that we can come to a bilateral arrangement which takes some pressure off the sectoral tariffs.
Mark Carney has pushed back against claims that lifting counter-tariffs is surrender. He argues Canada is protecting strategic sectors while ensuring Canadian goods keep their unique advantage in the U.S. market. By removing retaliatory duties, he signals that Canada respects the current agreement and is positioning itself for the next phase of talks. His priority is stability. Canadian businesses want long-term certainty before making new investments, and that stability depends on clear rules. With the U.S. Carney's approach is to demonstrate that Canada can maintain its access to the American market while also exploring diversification abroad. His upcoming trip to Germany with key ministers highlights this push. Rather than backing down, Carney is choosing to secure leverage and keep Canada's position intact as negotiations intensify.
Our negotiations with the United States have been taking place as the U.S. has been in the process of fundamentally transforming all of its trading relationships.
The toughest work still lies ahead. Renegotiation of CUSMA could take up to 18 months, and both governments know the stakes are enormous. Daily trade between the two countries is worth an estimated $2.5 to $3 billion US, a figure that underscores why neither side can afford prolonged disruption. Trump wants to prove that his tariff strategy can reset terms in America's favor. Carney wants to show that Canada can protect its privileged access without conceding vital industries. The unresolved disputes over metals and autos remain serious obstacles. Integrated supply chains, especially in autos, continue to face pressure. Yet Canada enters this stage with a strong advantage. It still enjoys the lowest average tariff rate of any U.S. trading partner. For Americans, the partnership secures energy, auto parts, and agricultural inputs that cannot easily be replaced. For Canadians, the United States is still the dominant market. The coming months will test endurance more than rhetoric. Trump's pressure and Carney's patience are now on a collision course. The question is not whether one side will fold, but whether both can find a balance that secures North America's economic future.
The president teased the tariffs on semiconductors that could be set as soon as next week. Those tariffs could be between 200% and 300%.
It's bananas, it's berserk, and it's a little bit crazy all at once.
President Trump has declared that tariffs of 200 to 300% on semiconductors are coming within weeks. His goal is direct: push electronics and technology companies to move production to the United States to avoid crushing costs. The plan follows a carrot-and-stick model, with lower rates at first and far higher ones if companies do not build factories on American soil.
I'll be setting tariffs next week and the week after on, I would say, chips. Chips and semiconductors. They don't open here. They have to pay, in some cases, 200%, 300%.
This is presented as proof of his promise to bring manufacturing back. Yet behind the rhetoric lies a policy more threatening than practical, lacking a consistent framework that industry can rely on. The timing is especially fraught. U.S.-China relations remain tense, with new threats of tariffs tied to Beijing's purchases of Russian oil. China is still the dominant exporter of rare earths to the United States, which makes Canada's resources even more significant. Some of the minerals essential to chip making are tied to Canadian supply, leaving Washington dependent in ways tariffs cannot change.
Okay, well, he actually mentioned a possible exemption for companies that manufacture here in the United States. How would that even work? He keeps saying, come this time next year, all the manufacturing that's going to happen. We see no evidence of any of those plans as of yet.
Bringing complex supply chains home in a single year is not realistic. Semiconductor production depends on infrastructure that takes years to build, from advanced fabrication plants to clean rooms and lithography equipment. It also requires thousands of skilled engineers and technicians, a workforce that cannot simply appear overnight. Most importantly, production hinges on access to raw materials. Critical minerals such as gallium, cobalt, and graphite are still largely imported, and China remains the main source of rare earths for the United States. With Washington and Beijing on opposite sides of key geopolitical disputes, the risk of disruption is high. Tariffs may create headlines, but they do not solve shortages of minerals that are essential to the modern economy. This is where Canada enters the picture. Beyond oil, gas, and uranium, Canada holds reserves of minerals vital to high-tech manufacturing.
David Eby alluded to this critical mineral when outlining how BC could help provide leverage in a tariff battle with President-elect Trump. But why? What's germane about germanium?
If the United States doesn't get this metal from the Teck smelter and trail, it's not available at all.
Germanium stands out. It is a key material in advanced semiconductor production, used to make high-speed chips and optical components that silicon alone cannot deliver. The only major North American supply comes from a smelter in Trail, British Columbia, employing about 1,500 people. Industry analysts call it indispensable for the next generation of electronics and defense technologies. If tensions with China escalate, the value of Canada's resources becomes even clearer. Washington may raise tariffs on Canadian metals or non-USMCA products, but the United States cannot easily replace Canadian germanium or other critical minerals. Ottawa therefore holds a position of leverage that tariffs alone cannot erase. In effect, pressure on Canada risks undermining the very supply chains that America is trying to secure. Canada has not stood still. Rather than rushing into a weak deal, Prime Minister Mark Carney has emphasized patience and rebuilding capacity at home.
We're talking about steel, auto, new sectors of the economy, including artificial intelligence, what we're doing in terms of making Canada competitive. Good to see you.
At a meeting with Ontario Premier Doug Ford in Ottawa this August, both leaders highlighted the importance of reinforcing steel, auto, and semiconductor sectors while investing in artificial intelligence. Their approach is to strengthen competitiveness internally, rather than depending on unpredictable decisions in Washington. Support packages for industries affected by U.S. tariffs are being paired with plans to expand critical mineral projects, including more than a dozen developments in British Columbia. These projects, worth tens of billions of Canadian dollars, signal that Canada intends to expand its role as a secure supplier. Far from yielding to American pressure, Ottawa is turning tariffs into an opportunity to accelerate long-term growth. In the end, tariffs of 200 or 300% can grab attention, but factories cannot be built overnight, and essential minerals cannot be conjured at will. Without stable access to resources and cooperation from partners like Canada, the vision of a fully self-sufficient U.S. manufacturing base will remain beyond reach. What is unfolding is not only a tariff battle. It is a contest between political theater and economic reality. And in that contest, Canada holds more leverage than Washington might care to admit.
President Trump hit Brazil with a 50% tariff, the steepest against any nation. Trump's politically charged tariff on the U.S.'s largest supplier of coffee.
This is something to definitely pay attention to because it will mean higher coffee prices.
Morning routines in America often begin with something simple, a hot cup of coffee. For many families, that first sip is more than caffeine. It is a ritual that sets the tone for the day. But even that small comfort is no longer immune from politics. After President Trump imposed a 50% tariff on Brazil, the world's largest coffee exporter, prices began to climb sharply. A pound of ground coffee that cost $6 last year now sells for about $8. For importers, invoices that once totaled $10,000 now arrive at $15,000. Small cafes say the extra cost could decide whether they survive. This is not an abstract policy debate in Washington. It is a daily expense that lands on the checkout receipt of millions of households. What was meant to punish a foreign country is making mornings more expensive in the United States. Coffee is only one product. When tariffs spread across metals, food, and manufactured goods, the impact becomes unavoidable.
Watch, the U.S. economy has a case of foodflation.
Coffee up nearly 15%, ground beef up just over 11%. Egg prices hit by avian flu are falling, but still up more than 16%.
There's no doubt Americans are paying the tariffs at this point.
The Bureau of Labor Statistics reports that wholesale prices for fresh vegetables surged at a record pace in July. Overall grocery costs are up 2.2% compared with last year. Coffee is nearly 15% higher, ground beef more than 11%, and eggs remain 16% above last year's level. Aluminum and steel tariffs, introduced in March, now show up in canned goods, beverages, and food processing costs. Wholesale inflation climbed 0.9% from June to July, the sharpest monthly increase since June 2022. Economists had expected only a modest rise, but tariffs have sped up the pressure. At first, large retailers absorbed part of the burden, but that cushion is gone. With supply tightening and costs rising, families face fewer choices and thinner budgets. If grocery bills show the hidden tax of tariffs, tourism shows how those policies ripple through entire communities. Canada remains one of America's closest economic partners, yet relations changed on August 1 when Trump raised tariffs on Canadian goods outside USMCA to 35%. In response, Canada has turned to diversify exports toward Europe and strengthen cooperation with Mexico.
What happens in Vegas could spell trouble for the U.S. economy. Empty streets and casinos.
It's slow. When I drive down the strip going to work in the morning and I barely see visitors out there.
The tariffs were meant to squeeze Ottawa, but they are already hitting American communities. Tourism shows the clearest effect. According to the Las Vegas Convention and Visitors Authority, total visitors in June fell more than 11% compared with a year ago.
President Trump's tariff announcements angering potential visitors like Canadians.
Used to we have like lot for Canadian, and now no.
Flights from Canada dropped over 18%. Hotels, casinos, and convention halls counted tens of thousands fewer guests. In a city where a quarter of workers depend on tourism, the absence of Canadian visitors translates into real losses for restaurants, entertainment, and local businesses. What was designed to extract concessions abroad is instead draining revenue from America's own economy.
A vote for Trump means your groceries will be cheaper.
Trump promised tariffs would put America first. In reality, they are circling back onto American households and businesses. Coffee is pricier, grocery bills are heavier, and tourism is weaker. The weight falls inside the United States, where families and local economies bear the cost. Canada, meanwhile, is not yielding. It is adapting, finding new markets and holding leverage. This contrast shows tariffs are not forcing neighbors into quick concessions. Instead, they are exposing America's own vulnerabilities. The story of tariffs is not written in speeches, but in daily life. It is printed on grocery receipts, in tighter budgets, and in the empty hotel rooms of Las Vegas. What was billed as a show of strength abroad has become a bill handed to the American people.